Thank you so much for that, and thank you so much for having me. It's a pleasure being here. Without understanding more or less a word of last presentation, I would say, and I would assume that you heard a lot about uncertainty. Is that right? Yeah. And that's exactly where I will continue here as well, because looking on the financial markets, they are all about expectations. And expectations are shaded when uncertainty is high. And for sure, uncertainty has increased throughout the start of this year. So just taking a short brief back, ending 2024 and going into this year, we were optimistic. And why we were optimistic? Yeah, it looked quite good in the US. The US economy continued on a strong note. We were having hopes and small signs of a recovery in a quite sluggish Europe, and in a more positive scenario, even China could add to the growth potential as we saw it. And we were well aware of that Trump and his new administration would add to an intense news flow, and that would probably add some volatility to the financial markets. But we can now, after almost 3 months, just state that it was a more massive news flow than we had ever could imagine. And that has created more uncertainty than we and the market had expected. So what do we take with us after these 3 months, and what has changed? Because as we see it, the short to mid-term scenario has changed quite a lot. And we don't know where that will end up. But we see also in the financial markets that there has been significant, tremendous flows in all kinds of financial markets. The stock market, interest rates, currencies, everything has been affected. And I guess the most reasonable conclusion from that is that we will live with that for quite some time. For how long, I don't know. But we will have a brief look on what we expect and why we expect it. This uncertainty has, of course, created volatility, as said. But it has also created, I should say, a rebalance of the growth potential in the global economy from a regional perspective. And I'm pretty sure that you heard about that also in the previous presentation. Because when looking on the financial markets, and going back to this expectations part, we normally say that evaluation of a financial asset is not really relevant in the short to mid-term, because it's the news flow or the catalysts that are driving the movement in the financial asset, either if it's a highly valued asset or a low valued asset. But when the news flow changes and go the other way, then valuation comes into play. And that's exactly what we have seen in the beginning of this year, we believe. We have had a high valued stock market in the US, a low valued stock market in the Europe, and looking also if we include China, an even lower valued stock market there. And that could have been the case for a long time, as long as the news flow from 2024 just has continued. It's no problem, as we see it, with a high valued market in the US. If the economy and all the news is positive, the capital flows go there logically, because the profitability has been and is still very good. And then the sluggish economy in Europe isn't at all at that place. Then that market should be much more lower valued. Nothing strange with that. But what we have now seen from the new administration and what that brings us in terms of news flow, of course, the question mark regarding the US in the short term to mid-term, also long term if you want to, but more or less short and mid-term, that question mark is getting bigger. And what we, from a financial market perspective, see is that that uncertainty has created a catalyst for Europe And then it's quite interesting, because if there were some expectations and hope for a recovery in Europe, they have strengthened. I mean, not in the short term. We won't see it in the short term in economic data from Europe, but a little bit longer term perspective in terms of growth potential. They have increased to the positive for Europe. And that is exactly what has also been shown in the stock markets over the last couple of months. And that's not a short-term perspective, but as you all know, the financial markets are quite quick to respond to news. So even if we don't see it now, it has to be delivered more positive news if that will continue. But as long as Trump and his new administration continues to flow the market and flow the world with this kind of volatile, I would say, news flow, yeah, it seems like it can continue for quite some time. And then we have a situation where the regional growth balance expectations, and they are the base for where the financial flows will go, so to say, they will most likely continue. And that's a big, big difference compared to what we have had over many, many years. You will see a few slides on that later. The capital flows have been looking more or less only at the US market, and that has been logical based by growth in the US compared to the rest of the world, the stock market in the US compared to the rest of the world, and you have also seen it in the strong dollar. All those things have changed in the beginning of this year. So this is quite interesting, taking that into what we see and what has happened and what most likely will continue to be the trends going forward. So when we look on a broader allocation, as we do when we put this investment strategy forward, we look on the big asset classes and split that up to different subsectors, so to say. We are still positive. We were even more positive in the beginning of this year. But in general, we see the global economy. It is more uncertainty. But if it falls out a little bit as we expect, we believe there are support for equities as a group, so to say. But we have made changes within the regions, as you see on this picture. We have decreased our exposure to the US market, and we have increased the exposure to the European market, and then some smaller adjustments here as well, but that's the big difference. And again, we hadn't done that if the news flow hadn't been this volatile as it has been in the beginning of this year. And we hadn't done it, I believe, even if we only, so to say, have had the volatile news flow from the US without anything else happening. But what we have had is the volatile news flow from the US in combination with the positive news flow from European in terms of physical stimuli and the infrastructure news that we have had in Europe that will most likely add to growth here. So then we come from a situation where the sluggish growth in Europe may change over time. So this is something we have done, and this is something we believe will continue to some time. Of course, you should have both regions in a well-diversified portfolio, but the focus from investors, as we see it, won't be as clear on the US as it has been for quite some time, and not least in 2024. And many investors haven't looked very much at all in Europe because of reasonable reasons, but that has changed. And also, to some part, you see here emerging markets, as we have reduced that underweight a little bit as well, and that's because we have a more positive view on China, where we also have had new stimulus packages coming out that probably will add to that growth picture as well. And then we have the situation that has happened. And of course, one can say that, yeah, but this has already happened. We have seen that in the pricing. So why should we expose ourselves for that going forward? But this is just a short-term correction we have seen right now. If the news flow continues as it does right now, it can absolutely continue for quite some time. And I will show you a few basic pictures, slides, charts to show the reasoning behind this. This is a little bit what you saw in the last picture, but the first picture you see here is on general, all macro data coming out from the European region and the US. And when you are below zero here, the outcome is mostly below expectations, negative for markets. And when you're above zero here, it's mostly positive surprises. And this has changed, as you see in this picture. European economy is now surprising on the positive side, US on the opposite side. You saw in the last presentation, for example, the consumer in the US, important data coming out here. So this is a little bit of change. And if you go back and you look on this for a long time, it has been the positive surprises for the US for a very long time, and exactly the opposite in Europe. This might be changing right now. And exactly the same looking on the central banks, the expectations there. The market is now expecting more rate cuts from the US economy compared to the European, and that's the opposite compared to the situation we had in the beginning of the year. But then looking on the financial market and how they are valued, there is also a reasoning that's interesting behind this, because looking in the end of 2024, we often got the question, but the US market is so high valued, isn't that a problem? We said, no, it's not a problem, as long as the news will continue on the positive side, as it did back then. But regardless of the new administration in the US now and the question marks about that, we are also now seeing signs of the US economy slowing and the positive for Europe. And then we have seen a quite large revaluation between these two stock markets, as you see on the first picture here. The American stock market was almost on a premium to the European market of 70%. It has fallen back significantly and is now around 40%. That's, of course, quite large premium still. But again, I won't be able, and I will not try to say exact the level that this should be, but it's still room for further reallocation, so to say, and as long as the news flow goes the same way as it has done in the beginning of this year. And also looking at this second picture here, it's interesting to see that what is driving the stock markets in the two different regions. The first yellow line, that's the US market, and you see when this line is falling, so-called defensive stocks, stocks not related so much to the business cycle and where the growth is heading, they are outperforming. That says something about that investors are a little bit worried about the growth in the US economy, and the defensive stocks are outperforming the cyclical stocks. That's exactly the opposite you see in Europe. The cyclical stocks are outperforming the defensive ones. And that tells us that investors looking on the European stock market, they are looking for better growth. And in US, a little bit of the opposite. Again, this is quite interesting to have in mind when looking on the different stock markets. Defensive stocks are normally outperforming when the market is in turbulence, and the turbulence is more related to the US than in Europe right now. And that's also very unusual, because when the market normally goes into uncertain situation, money flows, normally capital flows, goes to the US market. But that's, of course, not the case this time, because much of the uncertainty is related to the US at this stage. So then, okay, all of this, yeah, you have seen this happening already, so why I'm telling you this now. But looking on a longer-term perspective, this might only be the start of a longer period of and stronger performance of European equities compared to the US. Because looking on the long term, you have seen the US outperforming for quite some time. Here you have yearly performance, US stock market compared to European. And as you see, more or less all years, 10 years back, the US market has outperformed the European market. Not anything strange with that. The profitability has been much better, and the earnings growth has been much better. But now, with this uncertainty we have right now, it is a question if that will come back to the US favor, or if we will have capital flows going to Europe for quite some time, and then we could very likely continue on this path that we have seen in the beginning of this year. Thank you.